Welcome to the Real Estate Power Play Podcast, your launch pad for skyrocketing success in real estate investing. I'm your host, Gabe Rodarte, alongside Mark Monroe. We're ready to bring you transformative stories, groundbreaking strategies, and the insider secrets of real estate giants. Get ready to accelerate your investment journey and become a true power player in the world of real estate.
Hello, my name is Mark Monroe. Welcome to another episode of Real Estate Power Play. Thank you guys for all joining us again today. This is one I'm super excited about. I know Sohail for quite some time. We're in a seller financing. Well, actually, no, it's not even seller financing. It's just notes in general. So we're in a note mastermind where we meet a couple times a month, and we're actually going to be meeting tomorrow or Friday. I don't know. You live closer, so Sohail, why don't you? Thank you so much for coming on. Why don't you go ahead and introduce yourself a little bit about yourself and your company, and then we'll talk a little bit more. But thanks so much for coming on. I appreciate it.
Absolutely. Thank you, Mark. My name's Sohail. Been in servicing originations, compliance, legal, regulatory in the mortgage business for now almost 28 years. I own Provident Loan Servicing, and we just went nationwide with our note servicing. Some of the things we do that is our specialty is wrap note servicing. And of course the your regular seller finance notes, the private loans and things like that. We'll service those as well. We've been growing ever since we were founded about 4 years ago, and now we're nationwide. So that's a little bit about my background.
That's awesome. I love it. Nationwide. Congratulations, by the way, because that just
Thank
recently
you.
happened in the last couple months. So awesome. I love it.
Yep, just it literally just happened, and we had been trying to be in that space for ever since we started, and all of a sudden everything just fell in place for us.
Awesome. Congratulations. I love it.
Thank you.
So we're gonna talk a little bit, really dive in on some of this stuff because you and I, and thank you so much in my seller financing group, always giving some value to people because a lot of people in the note space and doing seller financing and doing creative deals or wrapping or whatever don't really know a lot about the compliance. And that's what's so scary. They're going through these mentorship programs out there. They pay all this money, but they're not learning regulations. And it's scary because they don't know what they don't know. And I can't tell you how many, and I think I referred people over to you before. I can't tell you how many times I've had these people go through a mentorship program, pay $10,000 learning a certain strategy, subject to and whatever it may be, and now they're put themselves into a bad situation because they didn't know about the regulations and rules. Like, I had that one gentleman that reached out to me a couple months. I sent over to you where, oh my, that thing was a mess on so many levels. They're getting sued by the seller for $130,000, and so thanks so much for putting that in there. So what are your thoughts on that a little bit before we dive in a little bit? But in general, because you and I have been at this close to 30 years, each, and we've seen a lot happen and change over the years. So, what are your thoughts on where it went and the journey and where we're at now in the space?
So the the way I see the industry, it's still fragmented, and everyone seems to be doing their own thing and listening to different gurus who have really maybe closed one transaction that was creative finance, and now they're teaching it. And it's really there's no science behind it. It's a very simple process, and it's so easy to complicate it, which is what a lot of people do. What they make it worse is by trying to become very creative in the note, putting in verbiage that makes no sense when all you have to do is let the attorneys draft the note the way it should be drafted. Don't put in unusual or strange things like a 3-year balloon on a consumer note. That makes no sense. You shouldn't do that to begin with. There are other provisions that I've seen where it's an arm with a balloon and a prepayment penalty, and come on, that's just you're actually hurting your own client or your borrower because they are your client at the end of the day. If you're the lender, you're lending money to these guys. So don't it's easy to get carried away to thinking that you're trying to protect yourself, but it has the opposite effect. And so it's always best to consult with an experienced person or just an attorney who will advise you on these things, and just don't put in these contingencies that could actually later be could be contested in court if it gets to that level, and you could lose your
You
entire
did say
investment.
something. You did say something there, and I want to back up for 1 second because a
Sure.
lot of people don't know this. When they're structuring these deals, they don't think and don't even know that they're a lender. What are your thoughts on
Yeah,
that a little bit? And I think we should talk there just for a second because that is something that most people don't even realize. They just, oh, they're an investor. So let's talk about that. How are they looked at and why are they a lender when they're structuring these deals?
because you are the one who will be receiving the payments from your borrower. You have a promissory note that's signed by these borrowers. And so you are, in essence, becoming a lender of record for these borrowers. The way we have our paperwork set up, we will literally, our documents say lender slash investor, because we get a lot of questions like what you said. Many of these folks don't think of themselves as a lender, they think of themselves as the investor. So we help them identify and understand that they're no longer just an investor, they are an actual lender of record for these borrowers. And that's how basically we keep trying to get the process moving forward.
Nice. I like that. And let's talk a little bit like when these people are structuring deals or creating notes and wrapping or doing a seller financing, what are some of the biggest things that they should be aware of, especially if they're putting in if they're putting an end buyer consumer into that property versus an investor? Why don't you take a few minutes, kind of go through like what are the big issues and why they should be concerned about it and all the different regulations. So this could go on for a few minutes, but go ahead and just start diving in.
So the regulatory agency, which is the all encompassing the federal agency, it's called the Consumer Finance Protection Bureau, CFPB. CFPB was formed after the housing meltdown, the housing crisis of 2008, to sort of rein in all these different lenders and the predatory methods that they use to lend money to unsuspecting borrowers. So CFPB over time came up with a certain criteria, and they said, well, these are some of the things that are allowed, and then these are things that should not be done. Now they've restrained or refrained from using the term prohibited, but then some of the states have come out with some of the prohibitions because, in addition to CFPB, each state has their own regulatory body to regulate lenders. Now, if you are doing loans and you eventually want to make that your business, you can only do three before you are required to be licensed. And depending on which state you're in, it could be, I think CFPB is three or five, but in majority of the states, you can only do three before you are either required to be licensed or you must use a what is called a residential mortgage loan originator to originate your notes. In my mind, it is best practice to always use a residential mortgage loan originator to qualify your buyers, because one of the criteria that can potentially blow up in a lender's face is not checking to see or being so lax in approving their borrower and not checking to make sure that the borrower has the ability to pay. So essentially, what you're doing is you're
I want
setting
to
up your
interrupt
borrower
one
to fail.
second. I want to
Yeah.
interrupt 1 second. Sorry, because you said where it blows up in the lender's face. So just keep in mind when we're talking in content here that when we're saying a lender, if you are new to this and you're the investor, remember you are also the lender slash investor. So I just want to point that out. Sorry about that. Keep going,
No
talking
worries.
about that.
So I'll give you an example. Um, Selling a home to a borrower, not verifying their ability to pay, and it turns out that 70, 50, 60, 70% of their income is being allocated to making a mortgage payment. Now, we all know that mortgage payments may change, if there's a change in your taxes or your insurance, and that could cause your payments to go up anyway. So if you're doing it in such a way where the borrower, it's a struggle for them already, and if there's a payment change, then you are pretty much guaranteeing a foreclosure. Now, if this, depending on what state you're in, because there are foreclosures that are called judicial, and then there are foreclosures that are called non-judicial. Now, in even in non-judicial states, which I'm in Texas, Texas is a non-judicial state for the most part. If the borrower chooses to contest that foreclosure, it will become a judicial foreclosure at that point, and then you will have to go in front of a judge to explain to them why you did the loan the way you did. So it's always a best practice to use an RMLO and follow their recommendations on what works and what doesn't work. And this will prevent any potential issues, number one. Number two, you will not lose your investment. Um, then some of the other things you can do in addition to verifying their ability to pay is collecting enough of a down payment. If you're collecting anything less than 10%, you're pretty much guaranteed a foreclosure within 24 months. And I'm not sure if I'm speaking out of turn here, Mark, or maybe you might be able to shed more light on this.
It typically depends. Like, because I do seller financing, if it's less than 10% down, depending on the state, I'll sell it on a different type of like a lease option or an agreement for deed. But some states you're not allowed to do that, like Texas. So you got to be careful of that, which I think you can do in Texas, but there's a lot of little, and I don't do business in Texas on that, so I'm not sure. That's why I rely on experts, especially if I'm doing business a deal in a state that I've never done business in. I always look for a good attorney to advise me through that process.
Makes sense. And so some of those things can actually be impactful on your investment. Um, consumer loan is sort of frowned upon by the CFPB. If you do choose to add a balloon note, make sure it's at least 5 years out so you're not making it difficult for them to qualify. Here's how I look at these things, right? These borrowers are coming to you to buy a house. They want to live in the house, and this is the American dream, but they can't qualify for bank financing. Now, in most cases, people are creatures of habit, which means if they can't qualify for bank financing today, they're not going to qualify for bank financing 3 years from now. There's a very good chance that they will still be in that loan 3 years from now. So if you put a balloon, which is 2 years, 3 years, 4 years, even 5 years, I personally don't like balloons, but if you do choose to put a balloon, give them enough time and encourage them to become credit worthy to where they can refinance out of that note. Prepayment penalties are frowned upon. CFPB just does not like them on consumer loans. Business purpose loans, loans for investors, it's a free for all. You can do it all day long. Adjustable rate mortgages, same thing. If you're going to do an adjustable rate mortgage, make sure that the first adjustment does not happen before the first 5 years. And because of just the way, what I've seen is people will do it based on and I'm going to make it a little bit more of an industry jargon here. They will tie it to the Wall Street prime. And if the first adjustment was to happen today, that rate, whatever you sold them on, will definitely go up. It doesn't matter what the rate was; it's going up, and it becomes impactful for the borrower because guess what? They may not have the ability to pay.
Nice.
So those
No,
are
that's
just
good.
some of the things.
Yeah. No, and that's why I really wanted you on, because it's really, besides we're going to get into the loan servicing, but the purpose of this episode is really to help educating people to learn, because they don't know what they don't know. And I see, and we see it time and time again, people posting stuff and like, what? And then that video, I mean, I sent you that video 2 weeks ago where that one guy I like did a seller financing note, and if any, where he did a seller financing note, and then the
Mhm.
seller, I think it was a $500,000 note. The seller wanted to get paid off, or he wanted higher monthly. So he renegotiated. I think his mortgage payment was like $1,500 and the seller wanted 3,000. In the market rent on it, I think he said it was 3,500. I'll post a video and I'll do something on that in a little bit. But then what he did was the seller said, he said, okay, I'll go ahead and do it, but I want you to do a promissory note on my LLC and remove the deed against the property.
Yeah.
And now the seller has no security against it. And like, I guarantee the seller had no clue what they're doing on that. What you remember, you saw that video, right?
I saw that video and almost had a heart attack because he just basically ripped off the seller. That's what it was.
Yeah. And it's just, and he's bragging about it, like, and so if you listen to that and you watch that video, and I'm sure some of you guys did, and you think, oh God, that's genius, because people don't see it from the seller's point of view. They're seeing, oh, I can buy these properties because he paid, now that property is free and clear with
Mhm.
500,000. And he ripped the seller off. And that's not, it's, and if anybody in my group that I mentor or anything like this, if you ever do something like that, I'm gonna hunt you down. So you got to do the right thing. And that's one thing about this industry, is because there's so many opportunities like that that come up. You have to do the ethical thing. And that's one of the main reasons why I respect you so much, because it's all about ethics in this business. And if you're not doing ethics and be able to put your head down, and we don't police ourselves, the regulators are going to come in. And we've seen it. You and I have been in this business for so long, where the regulators come in and they end up regulating the whole entire industry. You've been there. I mean, I remember before Section 32. Remember those days?
Oh my God. Yes. Yeah. And they now they returned it. They call it the high cost loans. And so they sort of, pardon me, they sort of exist, but Section 32s were just something I would never touch. It was not a good thing.
Well, that's what it is. It's really what it is. So let's talk a little bit more about regulations just for a few more minutes, because there's different types besides the new agency, the the CFTC. Let's talk about, you have the SAFE Act, you have the
Yes.
Dodd-Frank, the rest. But once you kind of give a quick overview of what that is and what they look for, and because there's different regulations within it, there's several different ones. So once you kind of give a little bit education on that.
So Dodd-Frank is what I just touched on. These are some of the things that are implemented by the CFPB. The SAFE Act is basically the same thing, ensuring that the loans are done in a compliant manner, and just making sure that there are no, we sometimes call them weasel clauses, and basically ensuring that the borrowers are protected, and they're not being lent like predatory lending, right? This was a term that was prevalent in the late 2000, around between 2008 and 2011, when everything just was on fire, or on fire as in burning down. And so predatory lending is something that's still a very hot button issue for not just the regulators, state regulators, but also federal regulators, and they will make an example out of anyone that does predatory lending. Um, RESPA compliance and really pertains to, if you're going to make this a business where you will do more than 3 loans a year, then it makes sense to use proper disclosures, provide your borrowers with the right disclosures, and the loan estimate, the TILA, the truth in lending disclosures. These are things that should be provided to your borrowers to ensure that they understand what they're getting into. And this way, if it ever comes out in court, at least you did your part. You did the right thing. You provided them with everything that they needed to ensure that they understood what they were into, and I guarantee you'll be just fine.
And then make sure also that you're using a closing agent or attorney to be able to handle this, a third party. You don't want to be the one
Yes.
conducting that.
Yes, no kitchen table closings. Don't do that. Use an attorney, use a title company, use an escrow company to do this. Do not do it on in your house, in a kitchen table. None of that stuff. It does not work out well for those people.
Exactly. And we've all seen it. You and I,
Yes.
over the years, we've seen these guys try doing stuff like this, and it always comes back and bites them right in the ass. And we've seen it time and time again.
Oh
So
yeah.
it's kind of
Oh yeah.
so you also I want to talk a little bit about your company here. Besides loan servicing, and we'll get into that in a second, since we're on this topic with regulations. In Texas, you offer the RMLO service too. Is that correct?
Yes, we do. We do. We offer loan origination services. Um, the cost is paid for by the borrower, unless the lender chooses to pay it. The cost is paid for by the borrower. So this is really not on you. If you're a lender, you if when you send your borrower to us, we will collect an application fee, which covers our cost of pulling the credit and making sure that these folks are not just qualified, but they're sufficiently qualified to where you, as a lender, are minimizing the risk of foreclosure. And that's really, at the end of the day, that's what we're trying to do. You're minimizing the risk of foreclosure. You're in compliance with all the federal and state regulations. And then here's the best part. If a loan is originated using a loan originator and done correctly, if you ever decide you want to sell your note, it becomes much more marketable to the buyers, that there's a big pool of buyers out there, and they will pay a premium for notes that are originated correctly using a RMLO, and then subsequently being serviced by a servicer. They will always pay a premium for it because there's more value.
Nice. No, that's good. And so when one of the biggest issues, and this is why people always want to do seller financings, because they don't want to go through the bank and they don't want to deal with that. So why would, if this is the case and they have to use an RMLO and go through all this, why don't they just, why is this in place? And what if they're a cash buyer? Like, how do you verify that? And do you care about the credit? What are you really looking at?
The good thing about using and being the lender as a seller finance is because you are the lender, create your own guidelines. You can be as flexible or as stringent as a bank. You can be much more flexible than a bank, or just be identical to what a bank will require. But if you're stringent, of course, the borrower might as well just have gone to the bank. Um, you decide, and you give the flexibility of what works. If the borrower wants to bring in a cash down payment, if that's what you're willing to accept, that's great. But just be careful with those things. You don't want to run afoul of the feds if you're accepting any cash. But if the borrower has money in the bank, it's not for, and this happens often, is when you go to a bank to qualify and you say, okay, I want to put 15%, 20% down. The bank will always look for the seasoning of the funds as to how long it's been in the bank, where the money came from, things like that. You, as a lender, have the flexibility. If you have a borrower with 20% down, they have it in the bank and they want to use that money as down payment, you don't necessarily have to figure out where that money came from or how long it's been in the bank. That's your decision. If you want to see it seasoned, you can say that. But if you say this is good enough, that works. And that will work in case if there's litigation. That will still work in front of a judge as well because you set the guide, and it was verified as to where they were coming from, and you're in good shape at that point.
And
So it just
then
makes it easier.
yeah, it does. So then at what point back to the SAFE Act, and when you're looking at it and using a third party, as us investor slash lender using a licensed RMLO, and you say predatory lender, like where does that come into play where, as us as the investor are structuring a deal where we could end up falling into a category where they could be looked at as a predatory lender?
Sure. So one of the two things where you could really be looked at as a predatory lender is if you are so currently for seller finance transactions, your rate can be tied to what we call the average prime offering rate. Now, because there are two categories of creditors: your banks or your typical lenders that are creditors, and then you have small creditors. Now, there's an expanded criteria for your small creditors versus banks. Your bank cannot there in order for your loan to be a qualified mortgage, that's the term they use. In order for your loan to be a qualified mortgage for a small creditor, your rate must not be 6% over the current prime offering rate. So as of today, if you are loaning money to your borrower and you choose to offer them at 13% interest rate, 13% is high, but it still falls within your cap of 6% above the average prime offering rate. Now, a bank cannot do that. The bank's rate at most cannot, would be about 11%. Or no, I take that back, about maybe 10%. So if you're at 13%, you're still fine. Now, if you go into 15 or 16%, then you are now into the high cost loan territory. It is a predatory loan and you can be sued for it. And when you get sued, it just means that the borrower doesn't have to pay you back because that's what the judge is going to decide. They get to keep the home and you lose your money. Alternatively, debt to income ratios. You can actually go expanded ratios. So a bank will typically look at, total income or 30% of their total, the borrower's total income as for the to calculate the housing ratios. So if your total monthly payment on your home is going to be $2,000, your gross monthly income should be at least $6,000, maybe more if possible. You can decide that you can say, look, I'll allow the borrower to have slightly expanded ratios instead of 30%. If my borrower's making $5,000 and the housing payment's $2,000, I'm okay with it because they still have some wiggle room in there. So now if you go $2,000 and your borrower's monthly income is four or less, guess what? You've now gone into the predatory lending territory. And that is hard to explain to a judge because you really set your borrower up to fail. So those are some of the things that fall in that category.
Got it. Now, the government programs, don't they allow up to like a 43% debt to income ratio?
So government programs, here's something very interesting that I'll tell you. Sometimes you can even go up to 55%, but it's really dependent on a lot of different factors, right? Credit, reserves, and the variety of things. And remember, VA loans are guaranteed by the Veterans Administration, so there's an implied guarantee in the background. With these, there's no guarantee. You're not protected. There's no mortgage insurance, none of that stuff. So conventional loans will go up to about 43%, 41%, maybe even more, depending on how strong the credit borrower's credit is. Do I suggest that you follow that route too? To a degree, yes. But you have to be mindful that the total debt to income ratio, and when we say total debt to income ratio, it not only means their total housing payment, it also includes their other payments like car payment, credit card payments, things like that. All of those included, if you go up to 40, 43, and I know I've had a few people disagree saying, hey, if we keep it that tight, people will not qualify or we won't find the right buyer for our house. I get that. Remember, you are the lender. You get to decide how far expanded you go. So you can be at 43% and still be fine. You can go 45, 48, that's fine. Just be mindful of the fact that whatever's being left over in income, they need it for their groceries, their electricity bill, their utilities, things like that.
That's
And
great.
if you're
That's
not
great
leaving
stuff.
enough on the table for them, then they're the ones who will be in trouble.
So that's great information on that stuff, educating on that in the compliance of it. So let's jump over to your your loan servicing a little bit and piggyback off of what you're saying. Like when you see those files come in, at what point, based off of the ratio that you're talking about, at what point do you start to see a default ratio start to kick in?
Two things that always Typically, when we onboard the loans, we don't really get to see the debt ratios, mainly because we don't see the origination documents. If we've originated it, then we get to see it. But if it's been originated by somebody else, or this was just something where they didn't use an originator, then we will never know what the debt ratios were. What we typically see is if you have a borrower that has put less than 10% down, then your chance of default just went up 50%. Typically, if you have a borrower
Did you say
who,
15, 1 5 or 50,
no,
50?
50, 50.
Okay.
And so currently, the way I was looking at our numbers a few weeks ago, so I don't, my memory is a little bit weak about it, but bulk of the loans that went into default within the first 6 months had a down payment of 5%. The other loans were a majority of them were also between 5 and 10%, but anything over 10% were still performing. They were a little bit slow, especially those that had been originated 2 years ago or so, where insurance and taxes had not gone up yet. And now that the insurance and taxes are going up, um, some of them have become slow paced. They've not defaulted, but the ones below 10% down payment have, for the most part, gone into default where there's a workout going on or they're basically in foreclosure right now.
Got it. Okay. So when you work out, what's that mean when you do a workout?
So when I say workout, it just means that the lender is willing to work with the borrower in either accepting lower payments, delaying foreclosure, or just doing a loan modification to help them continue living in the home and accepting slightly lower payments in lieu of a foreclosure. Now, obviously, if they default again, then it would be up to the lender to decide if they want to move forward with foreclosure or continue trying to work.
Got it. And that's one of the reasons if you do move to foreclosure, you need to make sure you have your paperwork in line because if they get an attorney
Yes.
and you don't have your if you didn't originate that deal properly, it could come back. And that was one of the biggest issues in 2008 and 9. When we saw a lot of those lenders didn't do the proper documents, and some people went years without having to pay their mortgage. Remember those
Yeah.
days?
Oh yeah. I remember those. We used to call the worst ones were the ninja loans. No income, no job, no assets, and they still lent you the money even if your score was
It was just
500.
a yep. It was just a heartbeat. That's all they needed.
Yeah,
Wasn't that
that's
crazy?
all they needed. Yep.
So, have you seen any of your investors slash lenders try to foreclose and they have problems because something that they did? Have you seen that?
Have a couple. Mainly because the origination was not done properly. The 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 provisions in the note didn't seem to make sense. We've had a couple where the one of them got contested, and eventually the lender had to write down quite a bit of money in order to get the house back. And then the other one, it turned out that the borrower was able to work things out and it was contested, but then they pulled it out of litigation and just they worked it out. So it's gotten better. For the most part, if you use a third party servicer, it becomes much easier to respond to requests from attorneys and courts and things like that. And it's all documented. So when everything's documented, it's just so much easier because you don't experience litigation as much as you.
So, do you guys recommend attorneys, I guess, that handles that in, like, say, for
Yes.
example, Texas? Do you guys do you guys handle that and pay a fee for that, or is that mainly on the lender side? How does that look? What's that look like?
So if a borrower goes into foreclosure, and so and I'll give you a little bit of a timeline as well. We'll help coordinate from start to finish. Your initial process is the demand letter, where I think the attorneys, depending on which attorney you use, we can make recommendations. If you have a preference of an attorney, we'll certainly work with them as well. So depending on the attorney, it could be 250 to 350 for the demand letter. If the borrower chooses not to respond, then it goes to the next step and ultimately to foreclosure. The entire process, we coordinate with you, we work with you on it. We have not been charging a fee for it. Now, it's a lot of work on our end as well because we're generating payoff statements, reinstatement letters, working with the attorneys, responding to any inquiries or questions that they may have. The loan is active in our system, so it costs us money. We've not been charging for it. I don't know if we will implement that anytime soon, and we don't even know what the correct fee would be for it. So right now, we just do it for free, and it the process can be as fast as 3 to 4 months in Texas to as slow as a couple of years in New York or some of the other judicial foreclosure states.
So, hey, what you mentioned that judicial and non-judicial. Why don't you talk briefly what that means, real quick, to listeners, so they have an understanding?
So non-judicial foreclosure means basically the lender, when the time comes, they will file with the courthouse and post it for foreclosure. You never go in front of a judge, none of that stuff. Judicial just means that there's a complaint that's filed. A complaint is like a foreclosure notification. Then you go in front of a judge when your time comes, you plead your case, and at that point the judge can decide if they want, they'll forward the process to foreclosure, or they may actually delay it. It just depends on the circumstance. But that's
And
in
then,
simple terms, that's what it is.
yep. And then certain states, when you start that process, that state like California, New York, they'll automatically assign an attorney to that homeowner, if you will, legal
Mhm.
aid or something, one of those things. So that's where things really get, and these legal aid attorneys really know how to pull it along, so these people get to stay there and live there for free in a sense.
And both the states you named are very homeowner friendly states, so they will do everything in their power to delay those foreclosures.
So if I do a loan, and I already closed on it, I have a loan on and I want to bring it to your company and you guys service it, what's that process look like?
So it's a very simple process. All our documents are listed online. Just download the paperwork, fill it out. The forms are fillable, and wait until the closing has taken place. Because we get inquiries prior to closing, and then one of the biggest challenges we experience is multiple emails coming in, which may have the same subject line, and some of them may not. And we're having to chase each of those emails to put them together and then onboard the loan. So if you wait till the closing's taken place and then you email us the setup documents along with the closing documents, and then it literally just takes us no more than 3 business days to onboard the loan and be up and running. One of the things I do want to point out, which happens often, is if you have not disclosed to your borrower the servicing fee, the fee, majority of the new closings that we get have the borrower paying the servicing fee. But if you did not disclose the servicing fee to your borrower at closing, then unfortunately that is on you, and you have to, as the lender, will have to pay for it. We will not police you in any way because we're not your legal reps or regulators. We will guide you on how to do it right, and we'll make recommendations. But the at the end of the day, of course, you as the lender are validating the fact that these notes are enforceable and that we can collect on them. So we will go based on that thinking, and we'll start collecting payments from the borrowers and disperse the funds to you when that happens.
So what's that look like? So you just disperse the funds to me, like if I'm doing a wrap, okay, like I say, it's subject to a wrap in the seller's mortgage. Do you send it to me and I pay the seller's mortgage, or do you do the payment, or what's that look like?
So the way that looks like is basically we'll collect the payment from your borrower, and on a wrap transaction, we'll collect it from your borrower. We will disperse the funds to the existing mortgage company, and then the remaining P&I goes to you. Now, one caveat. Um, we do get lenders from time to time saying, "Hey, I want to take care of this on my own." I will pay the underlying lien. That's great. Are you the named mortgagee or the mortgagor on that loan? If you are not the borrower on that existing mortgage and you actually bought the property subject to and then wrapped it, we will not let you make those payments. We will deal with that on our end. The reason we do that is in the past, we've had these scenarios, situations where we allowed the lender to make the underlying lien payments and they never did. So we were collecting the payment from the borrower, sending it to the lender, but those payments never made it to the existing mortgage company. Guess what happened? The borrower almost got foreclosed on because of the lender's negligence. So if you're not the
So
named borrower,
yeah, so
sorry,
how
go
does
ahead.
that work the opposite? Because like how I do mine, um, I want to make sure the payment's there before my buyer if I'm
Mhm.
wrapping it because I on the 25th of every month my payment goes out so it's there and oftentimes I'm not getting my buyer's payment for 2 weeks later then so how does that work?
So the
Because
way,
that could be a problem like on as
yes,
an investor slash a lender not knowing if that borrower has made the payment or not. Does that make sense?
yeah. So there's two ways to handle it. The first way is to make sure that you're paid a month ahead on the existing mortgage compared to your borrower's payment. So we just passed 11/1, right? So if your borrower's payment is due or was due on 11/1, then your existing mortgage company's payment must be due on 12/1. So if you're paid a month ahead and your borrower is late, or even if they make a payment on time and when we disperse the money, let's say it gets lost, for example, right? You are paid a month ahead, so you don't incur any late fees or late charges, and you will find out that the payment never made it. So we can at that point step in and either find the payment and send it back to the underlying lien holder. If your borrower hasn't made a payment, then you're aware that your borrower's late, and then we can take corrective action, whatever that might be. Once they go past the grace period, obviously we'll call them on a regular basis to collect that payment. There's one other alternative that I do allow uh, lenders to do. Now, this is rare. It requires an interview process with me. It is relationship based. So I know you, Mark Monroe, and I know you're good on for the money, on making the payments. When you have a portfolio of wrap loans where you want to make sure that those payments are taken care of, whether your borrower pays or not, so this way you don't have to think about it. I will, at that point, based on our conversation together, we will let you have that opportunity to take care of it. And the reason I word it this way is because I am very, very mindful of my reputation in the industry, Provident's reputation in the industry. I don't let all lenders do that. It's very few lenders where we will allow them to do it because now I am staking my reputation on the line with you to make sure that those payments get taken care of. Because if something goes wrong, guess what? We will be named in that lawsuit.
And I just want to put this out there as a disclosure, because I use some loan servicing companies, just so you guys are aware of this discussion, because I haven't run into it, but I've seen people run into the situation where some loan servicing companies will hold that check from the end buyer for a couple of weeks before they disperse the funds because they want to make sure that check clears from that buyer, so they're not out if they're dispersing the funds. Um, because I seen, and you and I had this conversation, I referred where they were having the lender disperse the funds and they weren't, and I love the idea of always paying in a month in advance. That's a great way of doing it. Because what happened was on this particular one, it was a wrap subject to, and these guys, because I always like when I'm doing a deposit, if I'm getting my money from my end buyer, I like to leave 3 to 6 months in reserves in the account to make sure the payment's always there to make the payments. Well, what happened was these guys took the money, didn't put any payment in ahead of time. And their end buyer, they started, they paid on the 5th. Then the following month they paid on the 9th. And then they ended up paying on the 18th. Well, what
Mhm.
happened was when they paid on the 18th, that loan servicer held that for 2 weeks. Now they're into the next month. And then what happened was that seller ended up having a delinquency. So just make sure you guys are on top. Always if you're going to do it this way, make sure you always have a month or two pay ahead so you're protected. And do you guys notify like the lender, like if a payment hasn't come in? So let's say, for example, you paid a month ahead and now we're in month two. How do us lenders be on top of that, or how is that communication done?
We have an online portal where you can, all the data is available. In fact, I forgot to tell you, we launched a new custom lender portal just yesterday. Um, we've already rolled it out to about three or four of our biggest lenders to sort of try out and look and feel. So far, the feedback is great. Basically, with the old portal or the new portal, you have access to the borrower's information, and it clearly shows that the borrower is late. Now, we won't call you and tell you that your borrower's late. We will eventually call you. Now, we don't call you immediately once the grace period has expired because that's too early. But once your borrower reaches about close to being 30 days past due, that is when we will call you. So by providing the portal where you have full visibility, we put the onus on the lender because this is not a 100% passive business. You still have to be a little bit active in it. So we put the onus on the lender to, if they don't see a payment come in, they can always go online and see what's going on, where the payment is. It'll clearly tell you if the borrower's late. And if we've had any communication, then it will have the conversation log, which lets you know what we spoke about and whether the borrower, if they made a promise to pay, what date they're going to pay, so at least you know where you are in the process.
Whoops, that's great news. I like it. So, we're coming to an end here. Is there anything that I didn't ask you that I should have asked you?
Well, the only thing I can really think of is make sure um, when you're going through the process, when you're originating the note, think about it from a borrower's perspective and ensure that they're excited, right? They'll be very excited about buying the home, so they may not have really thought some of the things through until after having bought the home. Make sure to protect yourself, everything is documented. And although this is not the question you asked, but just be sure that everything is documented. Use a RMLO if you can, and then a servicer to service the loans. It will give you that peace of mind and make sure that if any problems arise, you have the servicer as a backup to provide you with all the documentation, all the paperwork to ensure that things were done in a compliant manner. One of the things that we often hear is my lender never told me that. Well, we get it, but we did. And we have every call that we have with the borrowers, every single call is recorded. Even every single call with lenders is recorded. So if it ever comes down to it, we can provide you with the recordings to show that this is what the conversation that took place. So just always be sure to cover yourselves and try to do the right thing, and it'll come back to you in tenfold in a positive way.
I want to tack on. I want to add something to that because I've originated doing a lot of seller financing to wraps on end buyers, lease options, whatever it may be. One of the things you want to make sure if you're doing a property, you're wrapping it, you're doing a lease option, whatever it may be, if it's an older home and you're taking pretty much most of their down payment, like the 10% down, and they don't have a lot of money left over, make sure you have a home warranty there to help if anything goes bad, because I've seen it go bad before where they buy the home 2 3 months later, something major goes on that thing. uh I saw a septic system one time go, and they didn't have a home warranty. So be very, very cautious on older homes, and just make sure that if you're taking that large down payment from your buyer and they don't have much money left over, keep that in mind, because that's just a little tip. Newer homes, you don't have to worry about it so much, but so yeah. Anyways, thanks so much. How can people reach out to you if they want to learn a little bit more about you?
So two ways to reach out. Our website, which is providentls.com or providentloanservicing.com. or you can always call us at 214-937-0786. And anyone on my team can assist with answering questions. We have a pretty good team, and now it's a large portfolio of loans that we're servicing. But our goal is to answer 100% of the calls that come in. And so far, we're right at that number. We're at 99.9%.
It's
So,
awesome.
yeah,
Congratulations. I'm excited.
thank you.
Tomorrow or Friday, I'm flying to Dallas and
Yeah, I'll see
we're
you here.
going to the No Expo. So that's another whole thing, guys. If you're listening to us and you guys are originating seller financing deals, there's another whole world where you can actually sell your notes and go network with some great people. And I'm looking forward to it. So yeah,
Right.
you live pretty close by, right?
I'm about maybe 15 miles from the event.
Oh, you're lucky. Wrong, Lee. So I probably won't see you tomorrow. Yeah, I'm flying in tomorrow, so I probably won't see you tomorrow night. So I'll probably see you on Friday then. There's
Right.
no sense of
Yep.
going
I'll
in
be
there.
there
So
Friday and Saturday.
right. So, anyways, it was a great. Thanks so much for coming on. I'm excited. So if anybody likes this episode, please share it, like it. If there's anything else, also we will put in the comments the contact information and links, so you'll be able to reach out. So thanks so much for another listening to us on Real Estate Power Play.
Thanks, Mark.